Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Technology stocks continue to be one of the best places to look for great investments, and there are 4 technology stocks that I think investors can double down on today. That's what I'm going to go through. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to dig right into the first company. Everybody knows this name, and that is Alphabet or Google. Here is an overview of Alphabet. Not a cheap stock by any means. Price to earnings multiple of 29, next 12-month basis. Price to earnings is 22, enterprise value to sales of 5.7. But there is a reason that investors are willing to pay this price for a stock like Alphabet. I'm going to zoom out to the 10-year chart here. $290 billion in revenue right now. 10 years ago, that number was just $54 billion. That was a big company back then, but has just grown at an astounding rate since then. And I think there's a lot of reasons to be optimistic for Alphabet in the future as well. 3 that I want to highlight. And one is the thing that you're watching right here, and that is YouTube. YouTube is starting to play a more and more central role in the way that people watch video. It allows more people to upload content, so it doesn't have the same walled garden approach as a lot of media companies would like. But it's a great business for Alphabet because they're going to take a higher margin than a traditional cable or advertising company because they're doing all the work to sell all the ads and place the ads. So it just ends up being a phenomenal business for them. It's in a little bit of a slow period right now because some of the advertising spends from the big advertisers had pulled back. But I think long term, YouTube is going to be a phenomenal growth business. The second thing is artificial intelligence. Everything that we heard about Alphabet is that they are either number 1 or number 2 with NVIDIA in artificial intelligence. They have their own chips. They have their own cloud services. They're going to be a forward-facing interface for consumers to interact with artificial intelligence, whether that's through search or mail or any of Alphabet's other products that already have over 1 billion users. I think this is just going to continue to be another tailwind. And another one that may not get a lot of attention, but that's Waymo, the company's autonomous driving unit. Waymo arguably has the best technology today in autonomous driving, has launched its service for ride-sharing services in a couple of cities in the US and is starting to expand a little bit more. I'd like to see them build out the business model a little bit more, or maybe even sell that unit to a company like Uber. But I think there's a ton of value there. And so a lot of reasons to love Alphabet going forward. The second stock I want to go over is Spotify. And the thesis here is pretty simple. Spotify continues to grow extremely quickly. It's the one company that's focusing on audio. So even a company like YouTube is focusing on video and then is adding audio products. But this is a company that's just focused on audio. So think of it as the kind of the future of radio, whether you're listening to music or podcasts. And the thing that I think is astounding for Spotify is the growth rate. Total monthly active users in Q2 2023, so this most recent quarter, up 7% quarter over quarter and 27% year over year. I would have thought that growth would have slowed down coming out of the pandemic. People didn't have as much to do. Maybe they were listening to more music or more podcasts. It seems like the growth rate has actually accelerated coming out of the pandemic, and that's just a phenomenal sign. They're also increasing prices. And this ad-supported business, I think, should be starting to pick up steam over the next couple of years. $404 million in revenue in the most recent quarter. So not a massive business by any means, but just the kind of business that I think is going to drive a lot of value in the future. And Spotify is just one of those sticky products. Once you start using it, it's just something you continue to use, integrating itself into everything from smartphones to cars. And I think that gives a long runway of growth for a company like Spotify. The third one I want to talk about is not a big name and not one that gets a lot of attention, but that's Dropbox. I'm going to highlight 3 charts. One is revenue. You can see that Dropbox's revenue has just grown steadily over time. Not a massive growth company, but just slow and steady growth, which is what you like to see from a stock that's trading for a low teens price to earnings multiple. Free cash flow is a real focus of Dropbox. I think that's phenomenal especially for a lot of the companies in the tech space who have not been focusing on free cash flow the last handful of years. This is one that has the goal is to get this free cash flow number to $1 billion per year, something I think they can do in the next couple of years. And what are they doing with all that cash? Well, they're buying back stock. 415 million shares outstanding in March of 2021. Right now, 348 million shares outstanding. So just buying back stock at a steady clip. And that's the kind of thing that's going to add value to shareholders. Dropbox may not be a big name, but it is the kind of business that's very sticky for the people that use it. I think it's great that it's not part of one of these big tech companies because people are going to look for alternatives. Where do you put your content in the cloud if you're not on Apple or on Google? Well, Dropbox is a natural place to do that. It also owns its own servers and all of the places that content is stored. That not only helps lower cost, but it also improves the ability to add services. They're adding tools like artificial intelligence. That could be another value add service for them. So I just love where Dropbox is sitting. Investors are getting it at a reasonable valuation, 18 price to earnings multiple on a trailing 12-month basis, on a next 12-month basis, just a 14 price to earnings multiple. So love where Dropbox is sitting today. And the final stock for this list is Fiverr. Fiverr has really fallen out of favor with a lot of investors, but I think the pandemic really showed how valuable the company can be. And now it's just a matter of turning that value into more value for shareholders. It may seem like Fiverr is falling out of favor in a number of ways, but the business is actually still doing really well because the people that use it are used to using it and know where to find their services. Revenue was up 5.1% in the most recent quarter. Active buyers was flat, so they're not losing buyers. And the spend per buyer was actually up just slightly. The financial outlook is, I think, what investors really need to look at. Despite this being one of those years where a lot of companies are starting to cut back, where maybe some of the pandemic spending is not happening again, 6 to 8% year over year growth is what they're expecting. Their adjusted EBITDA performance was also just increased in their most recent guidance to $56 to $60 million from a previous guidance of $48 to $56 million. So cost reductions are starting to take hold. This is a company that I think like a lot of technology companies during the pandemic overspent trying to focus on growth. But the opportunity is now you have all that growth and they're not losing that revenue. So if they can get their spending under control, they're going to be in a much better position than they were just 3 or 4 years ago. Sometimes these out of favor names like Fiverr are just sold off with the rest of the market, and investors don't think about how much has fundamentally changed about their business. But I think this is one of the companies that is in a much better position today than it was just a few years ago. And as more people do remote work, do contract work, I think Fiverr is sitting in a very good position. So we went over 4 stocks today that I think you can double down on: Alphabet or Google, Spotify, Dropbox, and Fiverr. Which one of those is your favorite? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. And thanks for watching, everybody. See you here next time.